What's up, everyone? Welcome back to the show. Thanks for tuning in. My name is Mike. This is my whiteboard, and today we've got another trade checklist, but we're going to specify an earnings play on Apple. Today, Apple has earnings after the close, so this could be an opportunity to make a strategy or trade a strategy that encompasses that earnings announcement using a weekly expiration. And for me, I'm going to personally be looking at the chicken iron condor here, and I'm going to explain why and explain some of the benefits and ways that we can use this strategy specifically for earnings. So on the next slide, I'm going to show you how it looks in Doe and how we can display the expected move for Apple for that earnings announcement in the platform. So as you can see, we've got the strike bar here horizontally, and you can see this orange bar right between these strikes here. That is the expected move of the expiration that we're looking at. So we're looking at the expiration with 3 days left, so this weekly Friday expiration, which is the closest expiration that houses the earnings announcement since the earnings are tomorrow or after the close today. So if you don't have this earnings expected move here, what you can do is click on the settings button in the lower left corner, and there is a little button there that you can click to display the expected move for earnings. That will just make that orange bar appear, and then you can use that bar to facilitate the strike width to encompass your break-even points, or maybe even bring those strikes even further out to encompass that expected move and get a nice credit for this strategy. So here I'm looking at a chicken iron condor, which is really just a normal iron condor, but instead of collecting 1/3 the width of the strikes, we're looking to collect 40 to 50% the width of the strikes, which I'll break down in the next slide here. So on the next slide, we'll talk about where the stock price is right now. Apple's trading right around 105, and I looked at the specific chicken iron condor where I'm looking at the 102.99 put spread and selling the 108.111 call spread as well. So both of these spreads are 3 points wide, as you can see, but they're pretty close to the stock price, and I'm aiming for a credit of $1.45. The last time I checked, it was right around $1.39, so I'm waiting until I can hopefully get hit for that $1.45 value. Implied volatility will have to come up a little bit, most likely, for me to get filled there, but hopefully that does happen, which would basically give me close to 50% of the width. Remember, if I've got a 3-point wide spread here and a 3-point wide spread over there, and I'm collecting about $1.45, that's almost 50%. 50% would be $1.50, so I'm collecting just under 50%, and my break-evens are actually covering the expected move. My strikes are not, but my break-evens are, which is something I'm comfortable with. So when we're looking at the earnings chicken iron condor, it's basically the largest iron condor that we can deploy that gives us the largest credit while still covering the expected move. So this is why I like this strategy for earnings specifically. I don't route this strategy in non-earnings environments. I would much rather get that higher probability of success and just deploy a normal iron condor. But for earnings, when implied volatility is really high, a lot of times, especially in underlyings that are higher priced like Apple or even higher, Amazon, Netflix, Google, things like that, I can easily capture this expected move and collect almost 50% of the credit of that width that I'm looking for the iron condor. It's much easier to do it in a higher product or higher price product than in a lower price product. So that's why I like this strategy a lot. All else equal, when I'm looking at this strategy, my assumption is neutral. For me, I don't believe that the earnings are going to blow through my strikes to the upside or downside. That's just my personal assumption, and I'm willing to sell this strategy to show that. And when I'm looking at a chicken iron condor, as you can see, this one specifically isn't skewed anyway. We could skew it if we want to, and really when we're skewing an iron condor, all we'd really be doing is moving this call spread down a little bit and the put spread further away. That would give it a bearish skew because it would give it much more room to the downside to move. And if we wanted a bullish skew, we would just do the opposite. We would move the put side a little bit closer to the stock price and move the call spread even further out of the money to give the stock price more room to the upside. But as you can see here with this particular setup, it is pretty much equidistant, and we're looking at that very neutral assumption. For this strategy specifically, we are looking for that high IV environment. Of course, a high IV environment is going to allow us to collect more premium with these strikes here. If we had a lower volatility environment, these strikes wouldn't have nearly as much value. So it's going to be best for that high volatility environment. And for me, I always route this for earning strategies. I don't ever do this in a normal environment because I would much rather get that normal higher probability of success. With the chicken iron condor, since we're collecting almost half the width, the probability from a normal standpoint is going to be around 50%, maybe just above 50%, but hopefully that earnings announcement will create a non-movement or maybe a slight movement to the upside or downside, and that would allow me to realize the profit tomorrow morning when the announcement has already come out. So what are some things that can happen when the stock price does move? Well, we'll talk about that on the next slide. The very first thing we'll do is think about what happens when the stock goes up. Well, again, if the stock price moves up just a little bit, the volatility crush that I should see from the earnings announcement being released should offset any directional move that I see over the next few days or hopefully tomorrow. But if the stock price goes well beyond our call strike, so if they have really good earnings and the market interprets those earnings in a good way and we see the stock price blow through our call side, of course, our call prices are going to increase because right now they're out of the money. When they move in the money, both of the values of these options are going to increase, but the short option is going to increase more than the long option, and at expiration, it'll be worth 3 points more than my long option here, which would be putting me at a loss. My put prices would decrease, especially if the stock price goes well beyond that. My put options are probably going to be worthless tomorrow if that happens. But all else equal, if that does happen, I did collect that $1.45 of credit, which really helps offset my losses, which is one of the main benefits of this strategy. So if the stock price stays the same, this is exactly what I'd be looking for. I'm really looking for a non-movement or maybe just a slight movement, but really what I'm looking for is that volatility crush. So when I say volatility crush, really all I'm talking about is the effect that earnings has, or the effect of the uncertainty around earnings has on the option prices. So a lot of people are speculating either bullish or bearish, which of course results in people buying options when they're speculating, and it's going to increase the prices of those options. That increase in prices is going to increase the implied volatility, and what I'm doing is basically selling that implied volatility. I'm basically selling this spread for a credit, and I'm hoping that tomorrow morning the stock price stays within my range and I should see a volatility crush. It might not be a massive one, it might be a small one, but even if it's a small one, that indicates that the option prices have come down a bit, and that should allow me to buy this spread back for some sort of profit. If the stock price does go down, however, it's going to be the same situation as the stop going up, except my puts are going to gain value and my call options are going to be pretty much worthless. That's going to be bad, especially if the stock price goes below 99. If it goes anywhere in between here, maybe to 104 or 103, I should be okay, given the fact that I do assume that there would be a volatility crush. If volatility stays about the same, then I'd probably see a marked loss. But if my options are still out of the money, then I may look to either manage this spread, maybe move the strikes a little bit closer, or just hold it and see what happens until expiration, because at the end of the day, I did collect $1.45, which means my max loss is $1.55, and I'm totally comfortable with that. So what are some things to think about from a with this strategy? Well, on the next slide, we will discuss that. The very first thing I want to talk about is basically what we're looking for on the volatility and the earnings announcement, and we'll show that on the next slide here. So the very first thing would be the earnings announcement. When we're looking at earnings, especially with this strategy, if we're correct, we get paid more. So let's think about a regular iron condor. A regular iron condor, we would have strikes that are much further away, but we're going to collect a lot less. We'd probably collect around $1 by moving these strikes much further away. There's two things that can be good and bad about that. The very first thing is that we would have a much wider range to be correct. But the bad thing is that our max loss would be higher. If I collected $1 on this 3-point wide spread, my max loss would be $2 or $200 as opposed to the $1.55 or $155 that I see here. And one thing about earnings, especially with big mover stocks like Apple and Netflix, Google, Chipotle, all of those underlyings, when we see moves that happen, they tend to be large moves. And for that reason, I like to move my strikes closer, collect more, which offsets my max loss. So here, if we're right, we get paid. If the stock price stays in between this range, or if it doesn't move at all, of course, a $1.45 credit is going to yield a higher profit than if we were to collect $1 by using strikes that were further away. But if we're wrong and the stock price does end up blowing through our call side or blowing through our put side on the downside, since I collected more up front, that helps me offset the loss. It's still going to be a $3 loss if it blows through the call side, or a $3 loss if it blows through the put side, but since I collected more, that's going to offset that total loss. I'd have to buy back one of these spreads for $3, but I collected $1.45, which offsets that loss. When I'm looking to close this trade, I'm looking to close it on the open. So tomorrow morning, right when the market opens, if I am profitable and if I get filled on this spread, I would like to close it right away. Usually there tends to be some sort of movement, whether it's continuing the movement of the earnings announcement the day before, or maybe if there's a pullback. What I don't want to happen is to sit on it and get greedy and say, maybe I can just get a little bit more profit, and then see that profit dissipate as the market moves on the open. So what I'd like to do personally is close this strategy right on the open. The ideal setup, again, is collecting 40 to 50% of the wing width. So unlike a normal iron condor, where we're looking for 1/3 the width of the spread, here we're looking to collect a lot more to offset our losses and hopefully get paid more if we're correct. And just like the regular iron condor, when we're looking at the break-even calculation, and this is especially important when looking at the expected move, we're going to be looking at the same calculation. So on the put side, all we do is take our short strike of 102 and subtract the credit from that. And on the call side, we take our short strike of 108 and add our credit to that. Again, on the call side, we're adding the credit because when we're selling premium, the credit always helps our break even. So our break even is going to be added on the call side here, and on the put side, it would be subtracted below 102. So keeping in mind the credit we received and where our strikes are, I did cover the expected move of this earnings announcement with this particular setup. My strikes are actually, if the stock price does go to its exact expected move, my strikes are actually going to be in the money. So my strikes are a little bit inside the expected move, but with my break even coming into play, the break even calculation is what captures the expected move. So I believe if I am visualizing this correctly, my break even or the expected move comes right to about 109, and I believe it goes down to about 101 on the put side. If you pull up that same thing in the same strategy in Doe, I think you'll see that. So all in all, this is one of my favorite strategies for earnings announcements because of the fact that we have this great earnings situation where if we're right, we get paid more than a normal iron condor, and if we're wrong, we lose less. And the ideal setup is always to remember that 40 to 50% wing width. So here we've got a 3-point wide iron condor, and I'm looking to collect either $1.50 or a little bit less. For me in particular, I'm looking at that $1.45 mark. So let's wrap this up with some takeaways for you. The very first takeaway is that chicken iron condors can be nice earning strategies for those reasons that I just listed. We are looking to collect a lot more than a standard iron condor because of the fact that we want to get paid more if we're correct in that non-movement, and if we're wrong, we're going to be okay because we collected more initially, which offsets our losses at the end of the day. And lastly, pay attention to that expected move, and at the very least, ensure that the break-evens will cover that. So for my setup, my strikes are actually inside the break-even, or inside the expected move of the underlying, but because I collected more than that, my break-evens will encompass that expected move. So whether or not we're able to cover the entire expected move just by placing our strikes there, which would be the optimal situation, I'm still okay with moving my strikes in a little bit inside the expected move, as long as my break-evens will cover that expected move. So thanks so much for tuning in. Hopefully Apple stays right there, but we never know. In any case, my name is Mike. This has been my whiteboard session. If you've got any questions or feedback, shoot me an email here, or you can follow me on Twitter at DoTraderMike. We got Jim Schultz coming up next though, so stay tuned.